Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Steve Ankerstar. Allison is busy all week long studying for a Series 65 exam, which she takes on a Saturday. So fingers crossed for her, please. Obviously, you know, both her and Jaden finished their freshman year at college. Jaden brought home a 4.0. For those who've met and worked with Jaden, that's not even a surprise anymore. He's so smart. And Allison had brought his last semester, brought home a 3.9 and change. She's studying, so I would ask her exactly. I think it's 394, something like that. Had one B plus. Everything else was all A's. So couldn't be more proud of the team and the effort they put out forth, not only towards their own schoolwork, but also towards the company here, working with all of us and taking care of us. So today we're going to talk about three things. We're going to talk about Schwab stock and why I think there's a lot of upside. You may have noticed it showing up in some of the portfolios that you're in. Secondly, the difference between the popular income generation ETFs from JP Morgan called JEPI and JEPQ, respectively, and which one's winning. And finally, how big is the U.S. economy in relation to the world economy? I have a chart for you. Pictures say 1,000 words. So we'll take a look at that chart and you'll be impressed with how much we dominate the rest of the world, and why, you know, debt ceilings coming up is why I bring that up. And that's why, you know, folks are like, well, what if? And I'm like, it can't happen. It just can't. It would crush literally the whole world, not just the U.S. But before we begin, as a reminder, it's a financial education presentation and should not be construed as personal financial advice. Full disclaimer information available at ankerstarwealth.com. Now let's get started. I'm going to share out CNBC here with you. First of all, we're going to talk about Schwab stock. Why do I like it so much? Well, we had the big banking crisis. So here's the article from this morning from Raymond James. Can rally nearly 30%. I think there's even more upside from there. So why specifically Schwab? Well, Schwab has its ongoing merger from 3 years ago with TD Ameritrade. That's actually finally happening. It's happening over on the retail side now, as accounts are getting migrated across on the institutional side, which, if you don't know the difference, that means you have an advisor on your account. That means an institutional account. That's all going to happen over Labor Day weekend. That will literally be a hold your breath and wait until Monday or Tuesday when the market, you know, when everything goes back open, that should magically happen. We shall see. Big organizations, just don't be surprised if there are some issues, but tell you what, the team will be prepped and ready for you to stand by and resolve those issues as all those TDA accounts come across. If you came over early, congrats. If not, you'll be in with everybody else and we'll get you squared away soon. But when you really look about, okay, that's what's going on. And then you have the banking crisis. Is it a crisis when a few banks fail? It's a concern. Don't know if it's a crisis or not. But I think it's enough to stop the Fed from raising rates anymore, right? Because we don't want a full-blown crisis. But certainly we did have a couple of sketch banks fail. That may be unfair. Regionals, I should say. Smaller banks fail. Well, and the immediate question is how safe is Schwab? You know, I answered that to my clients before they asked it, right? Because that's my job, is to figure out what's on your mind and tell you before you even ask me the question. It's perfectly safe. I mean, it's as safe as a bank can get. It's huge. The balance sheet is rock solid. And, you know, they do a lot of right things, right? So, I mean, I'm not worried about Schwab at all. So I think, as you will see out of all of this banking mini crisis, if that's an okay label, is that everything's getting hit in the financial world. But as soon as the smoke clears, which the Fed stopping raising rates is that signal of the smoke clearing, is that, you know, we could be back to a better path in all of the financials, which really means, you know, especially banks that were unfairly hit like Schwab stand to snap back even higher than they were. So overall, super excited about Schwab. Again, ticker SCHW, that's shown up in many of your accounts. I also have KRE in there as well. That's all the regional banks put together. So super excited about that. All right, over to another bank, more of an investment bank on the JP Morgan Chase side. This is the headline that you will see on CNBC.com. Massively popular income ETF is getting beat by its own sister fund. Nobody gets, I have two sisters in the house and neither of them like to get beat by the other sister for sure. But they're talking specifically here about JEPI. JEPI is its name. It's JEPI. And I'll show you this chart here in a second. And its sister fund JEPQ, which fell right after it. So JEPE, which is the one I'm showing you right here, is equity premium income ETF. So what does that mean? They have holdings. So they have equities inside of the ETF, and then they use options to generate largely covered calls. There may be some more in there, but they use options they sell them so they generate income. And that allows you to take the dividend yield from the underlying stocks that you have and then sprinkle on top the options generated income for a total yield. Does it work? Oh, yes, it does. And it works fantastically. We got into this at the beginning of 2022 and we're looking for a move to safety, and 11.33% dividend. It pays out monthly. So you do the math, divide that by 12. That's almost 1% of your holding. So you put 100,000 in this, it's almost paying you 1,000 a month. That's pure income. Now, yes, it's also being taxed as income. The dividend has to be taxed as so when you get your tax form, it breaks it all out for you. So don't sweat that. But it is, taxed a little less favorably than a pure dividend, right? Because options income is taxed as income. So when you look at it, it costs 35 basis points. So it's really pretty cheap as far as all the work that they're doing for you. And the dividend yields up at 11.33. Well, the JEPE, the JEPI, uses basically the S&P 500 index stocks to serve from. You flip over to the JEPQ, which again followed in the footsteps. And of course, it's not going to give me a description there, but it's small and mid cap, or what some people call the SMID cap range, which it's not the S&P 500. It's the smaller companies, which are a little more volatile, so that generates a little more income premium. So the JEPQ, which we were in about 6 months, honestly, I didn't know about the JEPQ until I went to a conference in New York City, and they said, hey, this is coming out. We're basically mimicking everything we did for JEPI and putting into JEPQ. And I'm like, that's brilliant. Right into the little notebook it went. And sure enough, when it came out, into it we go, and it's been fantastic. So again, 12.65%. So that's over 1% a month that it's kicking off. It does move up and down. So it's not for the pure, I don't want to see my account go down by 1 penny, folks, that are out there. You need to stay with the USFR or something like that if that's what you want. But it does travel with equity. So in 2023, boom, straight up from 40 to 46, paying you 12% along the way. Will it last forever? Well, this is one of these things to where JEPI and JEPQ are good during a volatile market. So do you want a volatile market? Well, it doesn't matter what you and I want. We have to deal with the conditions that exist, right? So whether the Fed's raising rates or staying the same or dropping them, or whether this or that's going on, it doesn't matter to me as the fund manager. I look at all the investments and what's going to work best in that environment. Well, obviously we have volatility now. We probably will through the remainder of the year, even if the market does move higher, we're still going to have a volatile market because there's going to be too many unknowns out there. So during that time, these are great holdings. If all of a sudden we cure cancer, the war, Ukraine, Russia resolves, both political parties all of a sudden get along because we have so much in common, student loans are wiped away, everything's happy in the world, right? Then these would not be good investments anymore. You would simply want to buy the S&P 500 in that case, or stocks within it like we normally do. So these are not forever strategies, like, don't take my apple away ever, but they are perfect for what's going on right now. And they have been allowing us to outperform the rest of the market while we've had these for the past year plus. All right, the last thing I want to talk to you about is how big is that world economy? Excuse me, how big is the U.S. economy, especially in relation to the world economy? I love graphs because those are a lot better than words, right? It's not a graph, it's a chart. So I love charts. So this is a 2022, right? It takes a while for all this to trickle in. The world economy presented there as a whole circle is $100 trillion. Okay. Big numbers. And yeah, I know you're like, well, that's not a big number anymore because I watched the debt ceiling stuff. Yeah, that's scary. No doubt. Absolutely. Completely scary how much we are in debt. Yep. I can't even process that, honestly. But when you look at how big our economy is, 25 trillion. So that's basically 1/4 of the world economy. You have China on the other side of the chart, not just the world, but the chart, at 20 trillion, basically. So between the two of us, you're looking at 45 trillion, so 45% of the world economy. So that's why we kind of need to get along. And that's why it's so scary. I come from a military background. We always talked about the US-China, conflict and how terrible it would be. Well, it'd be terrible for the economy too. Lots of big weapons, lots of deaths. I mean, all that's terrible in its own, in its own war type fashion is terrible. But what it would do to the world's two largest economies would crush everyone else along the way. So we are all vested. Both sides are vested. Everybody's vested in that war never kicking off, right? World War I and II were bad enough. We survived them. Let's move on. Let's not do that again. But, so you look at the other players that are in here. You have Japan at almost 5 trillion. You have Germany a little over 4 trillion, and then India over 3 trillion. UK's in there over 3 trillion. So really, I mean, it's us and China driving the world. So that's why those two economies need to have their act together to continue to, make sure everything works in the world. If you will, not everything works. Make sure things work as good as they can. How about that? So anyhow, I just wanted to share that with y'all. All right, that's all I've got for today. Thank you so much for your questions. Please continue to submit your questions and comments through social media or directly to our email at vipservices@ankerstarwealth.com. Don't forget to like and subscribe. And with that, we will see you guys back tomorrow. You have a good one.